would say there's another element to this work that is really challenging that doesn't get as much attention as it should, which is just the fact that it is one heck of an emotional roller coaster.
Welcome back to the Clean Techies podcast, where we interview climate tech founders and VCs to discuss all things building and investing to solve the biggest challenge of our generation, climate change. Today we have an episode that was super special to me. We had the privilege to speak with Susan Su, a partner at Toba Capital. The reason this episode was special to me is that Susan was extremely genuine and shared some of the unspoken things about VC, namely that it's a tough business and it can be very tough to break into if you're not born inside the circle. Aside from Susan being a super pleasant guest, we also took a dive into her advice to founders, especially during the fundraising process, how early stage investors manage follow-up investments at small funds, and some of the difficulties and limitations of investing in deep tech as a small fund, among many other things. Overall, I found myself noting down a lot of things from this episode as it is really packed full of great content. I really hope you enjoy this episode as much as I did. All right, welcome to the show, Susan. How are you doing?
Hello, and I'm doing great. Glad to be here.
Yeah, I'm super excited to have you on. So let's just start with a quick intro to yourself. Can you tell us a little bit about yourself and what you're doing now?
Absolutely. So my name is Susan. I consider myself a capitalist, but also an environmentalist, and working to get rid of that but in that sentence for myself and for everybody else. I am a climate tech investor currently at Toba Capital. I am a tech operator, so I come from a background doing product and growth and marketing across a bunch of different tech companies. I've been an advisor, and hopefully they'll consider this as well a friend to many early stage startups and founders. And I'm a dog mom, a human mom, and just a general supporter of the climate movement across a number of other activities, which we can talk a little bit about later.
Yeah, certainly. I've been keen to, right off the bat, understand a little bit more about maybe some of your early career kind of challenges or things that really led you and helped you get to a point where you felt like you knew specifically what your goal in life was, or your kind of career mission, if you will, and also how that ties in with your climate journey.
Sure. Well, I would say my early career was pretty confused, as I think is normal for it to be. I kind of puttered around. I went to Stanford for undergrad. And so after graduation, I sort of got dumped into general Silicon Valley along with many of my classmates, and which was extremely fortunate because that was, by the way, a very unique time where things were just kind of coming out of um, the trough that was the early 2000s. And so I joined Google as my first job out of school. I did a year of AmeriCorps National Service, and then I joined Google. And I quickly realized that a 16,000 person corporation, which at that time it was 16,000 people, which is laughably small by today's standards, but then it was really huge, realized that that was not the place for me. I learned a lot at Google in terms of executional excellence, how to build culture, how to build processes and workflows that scale, and even then, so early, right? But I wanted to have a bigger impact. So I would say that a driving goal of my career, even then, early on, and to this day, has been this concept of having an impact. And it's probably actually just from like my millennial hubris, this desire to want to do something and be someone in the world. But at the end of the day, I think that if we can channel that towards something positive, then great. Let's harness everybody's arrogance into a movement and be productive with it.
Hey there. Quick break to remind any founders or VCs listening, if you are looking for deal flow, seeking to raise funding, looking for partners to help service your needs, or perhaps you're looking for corporate investment partners, feel free to reach out to us through our Slack channel, which can be found in the description. Because we meet a lot of people in this space, we set aside time each week to make introductions to the various people that we encounter. This is something we do free of charge in order to help these incredible companies solving climate change to scale. Looking forward to hearing from you in the Slack channel.
So from Google, I leapt to a small startup right into the financial crisis. And yeah, as you can probably guess, that didn't last forever. It lasted pretty long, surprisingly, but it didn't last forever. And I, along with many, many other folks, lost my job at that time, which was the greatest blessing. I had actually started out on the product side at Google and at that startup. And I really wanted to understand customers and learn marketing because I am a very empathic person. And I also just wanted to understand the psychology of what makes people tick and what makes people um, make the decisions that they do, especially en masse at scale. And so it was the combination of marketing, product, um, quantitative, qualitative, and that later became the discipline that is known as growth. Fast forward some years that I spent at 500 startups, which is now known as 500 Global, working with companies on growth and designing accelerator experiences around this concept of product and marketing led growth. And I joined a startup called Reforge, which is still one of my proudest experiences to date. It's a growth stage company today, but at the time it started out educating folks around growth and helping people to kind of in a meta way also grow their careers. Spent some time at Stripe, and then also decided eventually to round my way back into venture capital. So I have a very different path into VC than many VCs who have been kind of career in finance analyst to associate types. I was an operator for many years doing a lot of building. And so that was what got me into VC actually. My first uh, role outside of 500 startups, where I was actually still a builder in VC, was at Sound Ventures, which is Ashton Kutcher and Guy Oseary and Effie Epstein are the GPs of that fund. They brought me in to be their first and only portfolio manager, working across all of the many dozens up to 100 different portfolio companies that were part of their broader portfolio, which was an enormous privilege because I got to work with, I mean, Ashton and Guy started quite early and they've invested in some of the best companies, not only in Silicon Valley and LA, but in the world. So just getting to sort of interact with world-class founders was a great learning experience. But, like many people experienced in the 2018 to 2019 era, the wildfires got my attention. And I started to think that this area of concern and passion that I'd had for many, many years, pretty much since high school, but never, I'm not a scientist. I never really felt drawn to um, deeply technical type of work. Therefore, I always kind of assumed, well, me and climate change, we'll be friends, but we'll never be coworkers. And in 2019, 2020, that all started to change because the definition of climate tech suddenly exploded. It broadened out to be much more inclusive beyond energy, beyond deep tech, to really be about reinventing the way we do everything. So I kind of saw my chance and went on a journey of learning and self-discovery and relationship building, and that eventually led me to Toba, where I was brought on to lead the nascent climate practice that we have at our fund.
Interesting. This is really, really fascinating background. I love to hear this story. I'm kind of curious if could you talk a little bit more about getting into VC? You mentioned you worked at Sound Ventures to start in terms of being inside the VC side of things. Was there a lot of hurdles becoming because you didn't come from the finance side? You mentioned that your specific experience as an operator was helpful. Could you talk a little bit more to that?
Yeah, I think there definitely are hurdles if you don't have a deep background in finance. But on the other hand, if you are able to build and also demonstrate valuable skills that can be relevant to portfolio founders or teams, I think that's another way in. And like, I think VC is just shifting so much. The VC, it's funny because like that we're talking about this because we're just coming off of the SVB crisis. And in many ways, I think that Silicon Valley Bank represented a certain era of venture capital and the innovation ecosystem that is really starting to kind of crumble away in some ways. It's a little bit the VC of yesteryear. And now it's really just opened up. AngelList has, of course, democratized things dramatically over the last five handful of years. But aside from platforms like AngelList, there are just so many people. Like, what is a VC? Who is a VC? There's so many people doing a different version of it these days, and also there are many VCs that are really innovating on what their businesses are all about. So I do think that now is a really interesting time because there's a lot of chaos in venture. And I do think that people that have other skills, particularly skills in building things, whatever those things may be, whether they're VC, other VC backed startups, which is always helpful because then you have experience with venture capitalists, or whether there are other types of businesses, are definitely welcome in this space.
Hey there. Are you building a climate tech business and looking for very specialized talent? Consider reaching out to our sponsors, NextWave Partners. NextWave are experts in talent acquisition, recruitment, and retention across the climate tech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change yourself, feel free to reach out to NextWave at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page.
So at the time that I got in, I think it was still kind of early in some of these things happening. So it was difficult. I was fortunate because I had some brand names, on my resume that attract attention. And I have always hit it off really well with founders. VC is very much a relationship game. And again, like a lot of it is just being in the right place, right time. But I happen to know a lot of folks that were much more successful than I have ever and probably can ever hope to be. But some of those relationships are really helpful in opening doors. So when it kind of came to founder references or, just needing to sort of prove my cred to get into that role, I probably had some advantages there. So for anybody who's thinking about doing something the same, I would, think about what are all of your comparative unique advantages, but also know that VC today in 2023 is completely different than what it was in 2018, is completely different than what it was in 2012 and before.
Mm-hmm. Yeah, that's pretty encouraging. I think I believe we talked a little bit with Sean about being able to create more accessibility to Silicon Valley as a whole, and I think that would by nature also make more accessibility to VC as a whole. I'm kind of curious, one on a macro topic, do you have any opinions or beliefs on how climate tech venture capital has perhaps forced VC as a whole to change because of the nature of hardware being involved or there being something beyond just profit seeking?
Well, I'll maybe comment on that first note first, or on that last note first, I should say, around profit seeking. I see a lot of commentary, whether that's like the PwC reports that come out every year that are talking about the underfunded and overfunded sectors, or conversations on Twitter, or just general commentary that VCs and finance aren't doing enough to based to support the climate transition, or that we need to be here by XYZ year, and in order to do that we need to deploy lots more money, and venture capital or private equity or just finance in general are falling short. And I completely understand where they're coming from, because financing for, especially at the project level, is a really is bottlenecked, and it's a really important driver of deployment and adoption. But on the other hand, I would also say that a lot of that commentary comes from people whose job isn't to be a VC. At the end of the day, a VC is kind of like a small business owner. A VC is running a shop, just like so many across the world, so many other small business owners are. And a VC has to survive. And so, in order to do that, you have to understand the VC business model, which I think a lot of people overlook. And it's a very simple business model, but we often think that venture capitalists are there to kind of put money out there and support things and make them, kind of live in this world. Well, VC is not the same as philanthropy. And I don't mean that in any disparaging way. In fact, for anybody who knows the numbers, philanthropy dwarfs venture capital. I think philanthropy probably dwarfs all of private equity. So good on them. But VC, as a subset of the broader private equity ecosystem, has a job to do, and that's to drive returns. If we don't do that job, then we're out of the job. If we don't do that job, then we don't get the privilege to continue. And that's simply, and we can talk a little bit about this later, but that's simply the perspective of the LPs, who are, kind of the folks that are really calling the shots in terms of where capital goes at the end of the day. And also for many LPs, by the way, they are beholden to their own types of shareholders or other mandates and have a fiduciary duty to also drive returns. So I think your number one job as a VC is to do a good job being a VC, is to drive returns, is to turn a dollar into many more dollars so that you can continue, so that an innovation ecosystem can continue. And that's why it's called venture capitalist. It's an operator living within the capitalist system and has to be successful within that. So I would say that's kind of the first thing. In terms of your question about hardware and software, a lot of folks like to remind us that Silicon Valley came from Silicon Valley. It's called that for a reason. The semiconductor revolution in Silicon Valley was what created the kind of the first generation of wealth that became venture capital coffers that kind of funded the next generation, which was all around communications and software and internet. And then we sort of like got really into the internet and forgot everything else. So there's that whole narrative. I will say though that semiconductors are so fundamentally different than some of the hardware that we're seeing in climate tech. Semiconductors are a foundational building block to all of modern electronic and electrical society. And so that's kind of different than if we're talking about a more niche application specific piece of hardware for climate tech. I think that is a really important place for hardware, and there are some investors that are really good hardware investors, and I'm so thankful that they exist. And then there are other investors that know their strengths and weaknesses and will say, I actually don't know that much about hardware, and I'm probably going to lose money in this area, and so I'm not going to touch it. And I think that that is okay and commendable too. At the end of the day, our jobs as investors is to be great investors. That's our duty to our investors, and I would say to the innovation ecosystem at large, because if we fail, we all kind of fail together in the long run. So I think the hardware software dichotomy is a false dichotomy. There's a lot of software enabled hardware and there's a lot of hardware enabled software. It goes both ways. And it's really about investors picking their lane and getting really good at it and using that as a way to differentiate what they're offering out to the world.
Very good. I appreciate that. I appreciate that perspective. I actually just finished reading Chip Wars recently, so I'm very familiar with the origins of the term Silicon Valley. So quite interesting to hear your perspective on that. I'd like to dive a little bit more now into specifically what you're doing with Toba. If you could kind of speak to your role and things that Toba is doing differently and unique, would be very keen to dive into this.
Sure thing. So Toba is a venture fund that has historically focused on enterprise software because our principal and where the money behind Toba comes from was made in enterprise software. So that's been a core competency. But increasingly over the last couple of years, there's been an interest driven by personal passion and a clear view on opportunity to get into climate tech and sustainability. And so I was brought on to really build that practice up from the ground up. And we are now deploying across climate tech that includes software, that also includes some hardware, that includes a tiny bit of deep tech where we understand it and where we see great scale potential, and across a couple of other categories as well. So what's a little bit unique about Toba that I'll maybe call out here that's quite different than other funds is that we are backed by a single LP. And we're an evergreen fund. So we don't go out and, going back to the business model discussion for VC, we don't go out and have different fundraising cycles where we bring together a cohort of LPs into a single fund and then have to do that again a couple of years later and so on and so forth. We've got a single source of capital that is a single family office that has software roots. And then in addition to Toba, the Toba fund, that same family office also backs a number of other funds and really just invests across tons of different asset classes, real estate, public equities, hedge or sorry, late stage PE, yachts, you name it. And that's very unique because of the kind of bird's eye perspective that it gives all of us as individual investors, and especially me in climate tech, given how much climate and sustainability touch every part of our economy, including real estate, including late stage, even like project finance, including the public markets. Given how far climate tech reaches, it's really helpful for me to be able to kind of peer over to the desk of a colleague and see what's going on in another part of the financing ecosystem, as well as the fact that we invest in a lot of different venture funds, which gives me a unique view on what is happening in the venture ecosystem more at the ecosystem level.
Hey there, thanks for listening to this episode. If you made it this far, it's likely that you're enjoying the show, so I wanted to ask your help. If you're enjoying it, please give us a review on Apple Podcasts and share with somebody in the same industry who might find this interesting. And if you're interested in getting summaries of these episodes, go subscribe to our newsletter that comes out on LinkedIn and Substack. Links can be found in the description. Thanks for your help in growing the reach of this show. Interesting. That is quite fascinating to see that, I guess, strategic advantage, if you will, having a bunch of other people with different perspectives. I find it interesting in particular because I think it's often that people want to, at least from what I've seen a lot of times, VCs have a specific vertical, right? There's something that they try to focus on is their remit. I know they have to have, their PPM set up correctly with certain remits anyway, so maybe that's part of it. But oftentimes I find it that they're a little bit too stuck into their own world and they're not kind of taking the opportunity to learn from other spaces that could probably inform what they're doing. Interesting. So I think you answered most of the small questions I had inside of that, which was you do some hardware, some software. What are some things that you think are changing right now in the VC space? Especially, I'm kind of curious regarding, you mentioned you do some deep tech investing where you understand. I'm kind of curious if there are any things you're seeing around how either other firms or Toba is doing due diligence on deep tech. Do they bring in a certain team of experts from outside to help them with these things? Are there any other ecosystems popping up to help understand these very complicated things? Because especially with climate, you need to have certain understanding of the science, I think, if I'm not mistaken. So we're kind of curious if you see any other services popping up around to support those I guess inventors of technology to get their message across in a digestible way.
Yeah, that's a great question. To my knowledge, I don't know of anything that's really programmatic or codified. I know that a lot of fund teams have scientific expertise, kind of in-housed onto the team, and that makes a lot of sense to me. That is more on the diligence side, and that's less about, I think, communications, as you were alluding to. Um, I I personally don't know of any, sort of comms or like hybrid science and comms teams that are helping to bridge between um, deep tech companies or even researchers that are working on different solutions and kind of like the marketplace. But I know that, for example, I mean, sometimes when I reach out to folks that are just doing really cutting edge research, just published research, and they're a part of a university or another research institution, they'll often have some kind of arm of their institution that will handle, the quote unquote commercial aspect of what they're working on. So, there's that. But I would say the most common trend that I've seen is that um, VCs will just have people, will hire people that have deep tech expertise because they're coming straight out of a research institution themselves. And I think that makes a lot of sense. Not everybody, though, has the resources to be able to do that. So that implies quite a number of things about your fund size and the way that you're kind of planning out your own VC business. And so for the smaller funds that don't necessarily have that competency, that either needs to be part of the founding team or they need to steer clear of those areas.
No, that makes a lot of sense. I think it's difficult because without that information, it's basically just shooting in the dark, right? Um, I'm kind of curious about so if I remember correctly, you said that Toba does mostly early stage, is it seed or pre-seed investments?
We'll try to start at around a seed and treat that as an opportunity to get to know a team early on, with a relatively small, humble check, and hopefully find an opportunity to deploy more capital later on in a Series A and beyond.
Okay, so you do usually follow through. Okay. I'm kind of curious.
Well, I'll correct that. It's not a promise.
Mhm.
It's a possibility.
Possibility. Okay. So out of curiosity, just for somebody trying to understand the space more, what is I guess I'm just kind of curious to learn about when you make this initial seed check, right? And they hit their targets and they're going to the point of raising an A round. Usually how does this work? Is it typically that the VCs who invest early really would prefer to be able to invest in that round again? I mean, I'm assuming they're hoping for the success. I'm just kind of curious to understand logistics from somebody who's not in the space to understand how it works.
Yeah. So I think what you're asking is it always a good idea to follow on, or do VCs always want to follow on? And it just depends on, Silas, so many different factors. Like, for example, it's going to depend on what your mandate and your agreement is with your LPs. Did you say that you're going to be a very like early stage pre-seed seed focused fund? Did you promise that you're going to invest under a certain valuation? That might um, impact your ability and desire and appetite to go in at later rounds, depending on how those rounds are priced. Um, some funds are planning to raise their next fund in a very short period of time, let's say a couple of funds within a couple of years. And in those cases, they need to demonstrate relatively fast markups and a high IRR. IRR, of course, factors in time as much as the actual return. And so you're going to be looking for things that both have a very low cost basis and a quick, kind of quick timeline to markup. If you are trying to get in at the lowest cost basis and demonstrate the highest multiple on your initial investment, you may not want to dilute that cost basis by putting a lot of money into a subsequent round that is priced higher. That's just one example. On the other hand, there are other funds whose main goal is to put as much capital to work in the best places as possible, in which case they might want to really go big in a subsequent follow on round because now it's de risked. There are other investors involved. And whereas the seed stage version of that company maybe couldn't absorb 5 or 10 or more million dollars of capital, a Series A version of that company can absorb and effectively put to work all of those dollars. So it just depends on so many different the calculus of whether to follow on, how much to follow on, um, and in what way, through what vehicles. Just depends on so many different
Hmm.
factors. I will say that most VCs will not follow on, at least in a nominal capacity, because of the negative signal it potentially sends about
Mm.
investments in their own portfolio. You don't want to appear that you have so little faith in your own portfolio companies that you wouldn't even want to do your pro rata, for example, which is often just a much smaller amount of cash. So there are like so many dynamics when it comes to the decision to follow on, including signaling, but also including the goals of the fund and also like where that fund is in its
Hmm.
own business cycle, whether it's about to go fundraising or not, whether they have to fundraise. For example, Toba doesn't fundraise, so we have like a very different perspective
Hmm.
um, on the follow-on question. Yeah, so it's very, very case by case.
Yeah, I guess maybe the one thing I was kind of curious to understand is I've spoken with some people recently who specifically do pre-seed investing, and I was wondering, how can these smaller funds do a follow-on if the rounds are getting so much bigger, right? They can't probably put the same amount of percentage into the next round, right? So can you maybe help me understand how that typically works for these people who did early stage investing and they
Sure.
don't write big checks?
Yeah, sure. So normally that fund manager would have set aside some percentage of the fund to be able to follow on. So they do have some allocation kind of their fund that is already earmarked for that. if they do pro rata, the pro rata amount isn't going to be greater than the initial amount. So most likely, so it's just going to, that's not necessarily going to be a huge outlay. If they want to go big, go super pro rata in a subsequent round, or they want to, otherwise participate in a big way, there are some options open to them. Namely, they can put together a special purpose vehicle where maybe they lead that SPV and then they bring on some other folks to supply additional capital for them. And that gives them leverage. So they're able to still capture some of the upside from that larger chunk of money that they're investing, but they don't have to put up all of the principal.
Okay.
So they have some tools available to them, probably running an SPV on a larger allocation from the portfolio company would probably be the most straightforward for them, and affords them, access and upside. Well, they already have the access. It affords them upside on the access they already have to that portfolio company, um, if their fund is small and they can't
Okay.
do it straight out of the fund.
Okay. Got it. Okay. That makes a lot of sense. That's actually very helpful. I appreciate that. Okay. So now that I'm out of VC school, let's talk about what would you say is your most challenging part of your job, in your current role?
I think, contrary to public perception, VC is a really hard job. Any VC that tells you it isn't, or takes a more breezy approach, are like what we used to call, at Stanford, everybody would call the student body, say they're like ducks swimming on water, or floating on water, looking very serene on the surface, but just underneath they're just paddling furiously, to stay afloat and to keep going. And I think it's a little bit, I think this job feels a little bit like that. And I'll be the first in line to just be totally honest and upfront with everybody here. It's hard on so many different levels. You're basically running your own kind of competitive business alongside everybody else. If you want to take like a very blunt tack on it, we're kind of like, and I'm not the first person to say this, so I didn't originate this, but we're sort of like a real estate agent. Real estate agents are really competitive with other real estate agents. We're just salespeople at the end of the
Mm-hmm.
day, in many ways. And so there's a lot that you have to abide by in terms of rules, but then there's also a lot that you have to innovate on in order to break through um, and compete to get mind share, both from the founders that are most sought after, as well as LPs. So you're kind of like in the middle, selling on both sides, which is definitely one challenging aspect. But I would say there's another element to this work that is really challenging, that doesn't get as much attention as it should, which is just the fact that it is one heck of an emotional roller coaster. Most of us do this job because we love startups. We love innovation at the end of the day. Maybe we're not cut out, whether by character or by skill set, to go and be those founders that we back, but we admire them so, so, so much. And then our hearts are in it as much as theirs are. Most of us. I can't speak to all VCs, but I know that it applies to me and a lot of friends that I have that are in this business. And so, there are just like ups and downs, and you're kind of there with, and anybody that's been an entrepreneur will tell you that there are ups and downs, and it's just, it's an emotional journey as much as anything else. And the same is true for venture. Plus, add to the fact that there's all this like relationship kind of stuff that happens both between investors as well as between investors and founders. So it's a lot to manage, kind of on the social and emotional level. And there's no guide for that. And that's not something that a lot of folks will talk to you about, because everybody's also trying to like play their role. And for that reason, it can be both the most social of jobs and also the most lonely of jobs at times.
That's actually really, really interesting perspective. I guess I never thought about that. And it's a very genuine thought. Thank you for sharing that. I'm glad we could hear that from you. Um, Very good. So with that, I'm kind of curious to know, obviously you probably see a lot of pitches. What is some of your biggest advice to founders who are raising capital right now? Some of the big mistakes you see people make typically to veer away from, just general advice to them.
Well, I don't know if this is obvious, but I know many founders make this mistake that I've seen. So maybe it's not totally obvious, but let's say one thing is to plan the fundraise really well and then go execute it rather than plan it while you're doing it. And by plan, I mean everything from having all of your materials and data room and all of that sort of thing ready to go, which is obvious, but also really thinking in a strategic way about who you want to be part of your council. I used to say cap table, but it's so much more than a cap table. It's really a council. And that will help you in a number of ways. It'll help you envision and plan for future raises, and it'll help you envision a path forward for your company. But it'll also help you not kind of burn all of your like attention equity on the first go round. And what I mean by that is that it's very important to know who your um, to know kind of like your plan A, your plan B, and your plan C when it comes to fundraising. Now, not every single investor is going to be in your plan A. Some of them are going to be a plan B, and some of them are going to be a plan C. You don't want the plan B investors to know that they're your plan B investors. You don't want the plan C investors to know that you've already talked to a bunch of plan A and plan B investors. So for that reason, it's very important um, to to have a strategy and also a tiered approach when it comes to who you're going to talk to and when. You don't want everybody to have um, to know that you've been out in market for months and months and months, because that creates a negative aura around the company. And a lot of investors are friends with each other and know one another. So one of the best ways that I like to advise companies to do it is to just sort of build early relationships before it's actually time to fundraise. You can sort of soft fundraise for a really long time before you're officially fundraising. And ideally, because VC, like I said, is such an emotional job and can be a very emotionally driven business. And we've all heard of venture capital FOMO. Ideally, the time period in which you're actually fundraising is pretty constrained, just so that you, number one, are in control of your destiny and your narrative, but also so that you can, just create a little bit of time scarcity around when investors can participate. You don't want to be on the market for 9 months and counting, because then there's no urgency and people feel like they can just talk to you anytime. You also don't want to have talked to every single investor, because then a new investor that you spoke to is going to know that and is going to go and reference all of those previous conversations, maybe get a lot of things wrong in that game of telephone, and have a prejudgment on you that may or may not be favorable, and probably not. So it's really good to constrain your fundraise, um, and only broaden out to plan B when necessary, and only broaden out to plan C when necessary.
I like that. That's very helpful. I think that's very concise as well. Great advice. Something I've not heard people mention in that format before. We're basically out of time here, so I maybe just want to kind of close up things with one. What is your biggest, I guess, area that you're bullish on, or thing that you think in the next 2 3 years, it's obvious to you will happen, but maybe not obvious to others, especially as regards to climate and technology?
I think this is pretty obvious to everyone, but I don't see as many investors talking about it in climate as I do outside of climate, which is that I believe that large language models and AI are going to have a massive impact either way. It's going to make a lot of things a lot easier, and it's going to make a lot of businesses harder to build as well, as businesses. And so I would love to see more climate founders talking about that. I see founders outside in software talking about that a lot. But interestingly, in climate tech, where we have so much data, and a lot of solutions are really around making sense of that data and helping us make better decisions in the physical world around that data, I don't see as much discussion about that as I would like. Or maybe I'm just not part of them and I would like to be. Um, so that's one kind of area of both challenge and also opportunity.
Yeah, I think that is interesting. I mean, I have a coworker of mine who's very big into AI, and I'm oftentimes thinking to myself, well, this doesn't really seem to like work in what we're doing. But yeah, sure. I mean, it's cool. Maybe we can apply it to recruitment or something. But now as you bring it up, obviously there's probably many applications where we should be looking at this. I have noticed it seems like there's no mention of it in the climate space. That's kind of interesting. Okay, and final thing for anybody interested in getting into the VC space at some point, or particularly in climate tech VC, what is your advice to them? Probably let's curate it towards maybe early professionals who maybe have graduated and worked for a few years and looking to get into the space.
I would say start to get to know founders today, now, and see how you can be useful and understand. And also, I think building an actually useful skill is so, so valuable because number one, it gives you other options beyond being a VC. And number two, it gives you so much perspective and value add that you can bring to bear when you are a VC. A lot of folks aspire to becoming a VC kind of straight out of school. And I don't understand that because I think this actually really, in some ways, narrows your aperture. If you're young and want to make an impact and want to have be at the intersection of financing and startups and innovation, go start a company or go join one that's really early. Take these risks while you can, learn a whole bunch, and when you come out of that, on the other side of that like process, you're going to have so much to bring to your investing, and it'll be much easier to get that investing role, but it'll also be much more enjoyable and make much more sense. So I would say go out and get that real world experience. That's probably the number one.
Right.
Even if it doesn't ultimately end up in some kind of successful exit, that doesn't matter.
Mhm. Yeah, I think it's difficult as a young person. It's hard to be patient with that process of learning. I've had some pretty good bosses and mentors in my life calm me down and say, "Hey, just wait a bit. You haven't figured it out yet. Go read, Bob Iger's Ride of a Lifetime, and then we'll chat again." And I think it's very very helpful to hear. Any final asks or anything you'd like to leave the audience with, where people can reach you?
Sure, I would just say don't lose that impatience. It's incredibly important that we all have a little bit of impatience as well as a little bit of perspective to guide us through our careers and day to day. We need to get things done. We need to get a lot of things done. And I would say for everybody out there who's listening to this podcast, good on you for listening to the podcast. Now go and learn something else. And learn something not only in your direct field of where all your goals sit, but learn something that's adjacent to your goals and go and get perspective and be a better human because that'll make you a better XYZ fill in the blank, whatever it is that you're trying to do. As for me, I mean, I guess the only ask is reach out, build a relationship, like come say hi. I'm on Twitter, so definitely find me there. Love to chat with people and meet new folks whenever I can. And that's about it.
Awesome. Very good. This has been really, really great episode. Thank you so much for joining us and excited to see what you continue to do with Toba and the impact you make.
Thank you.